Recipes for technical trading success in Cook's Kitchen.
Are you ready for 3.5% growth in the second half? Well, get ready. I'm going to share the views of an economist who agrees with me on that growth outlook and why it will finally be what we're looking for to have some revenue growth and take stocks higher in the second half. First, let's review a couple things. On May 27th, I gave you 6 linchpins of an aging bull market where I talked about many of the things that would keep driving the economy and driving the stock market to new highs. You want to review that video and see all my slides there from May 27th. Just search 6 linchpins, just like the title says, the number 6 and the word linchpins. Search it on Zacks.com or in Google, and you'll find my video and the accompanying article. All the slides are in that video. All right, first let's talk about Greece and what's going on. Looks like there's been some good news where Greece is giving some concessions, saying, hey, not so fast. Maybe we don't want this to go to a referendum to our people and end up getting kicked out of the Eurozone. We'll see what happens. It's created some volatility. Let's take a look at the VIX chart. This is a one-year chart. You can see over here all the way on the right, the big spike in late June, up to nearly 20 on the VIX. A lot of people get excited and think, oh, the VIX is breaking out, the VIX is breaking out. Stop. The VIX is not breaking out, okay? That's not how the VIX works. Volatility as a stochastic process, it drifts along and then it jumps. And it tends to reflect daily price movements. So we had that big spike in the VIX up above 19 because we had a big 2% down move in the stock market one day this week. And really, if the market was expecting more big 2% moves, the VIX would be above 30 already. But we've settled back down, and a VIX of 16 is pricing about 1% moves in the market. So nothing to get excited about here. The VIX is not trending. It's not breaking out. It just made a jump. It's going to settle back down. It might make another jump. We'll see. All right, a better tool to use to gauge the ebb and flow of the market that I like to use is the high lows. And this is the New York Stock Exchange high lows. And you can see it here in late June. As we headed up above 100, I was looking for another move like this move in March up to 300. I thought we'd have a big surge to new highs as the stock market made new highs, and then Greece happened. Sort of took us off course. But this is a better way to play the ebbs and flows in the market. You want to buy the NYHL when it's below 100 and sell it when it's above 300. All right. Let's look at sentiment. This is Ed Yardeni's weekly look at investors' intelligence, the survey of newsletter writers like moi. All right, and the top chart is bulls against bears. Now, I'm not showing the ratio, but really that's what we want to focus on. So you look at the blue line, bulls, the percentage of bulls up above 50%, living in that 50 to 60 range in this bull market unless there's a correction, and look at the bears, the magenta line, all the way down there in the teens, almost as low as it was back in '87. Ooh, that's a little scary, huh? Anyway, that ratio of say 50 to 15 puts the bull-bear ratio at above 3, and when the bulls get up to 60%. And the bears are at 15, then you have that bull-bear ratio at 4. That's a place you want to sell the market. And you want to be in this bull market, you want to be buyers when the ratio gets down to 3. Now, classically, the best buying opportunities are when this ratio gets to 1 or lower. But we're not going to see that in this bull market right now. There's too many people invested, and we have enough fundamental signs to stay invested. So you're not going to see that ratio at 1 again unless we enter a severe correction, which I don't see. All right, now let's move on and talk about the economic reasons we're going to see here to be buyers of the market. Even if the S&P goes to 2,000, you want to buy it. This is, again, from Yardeni. He's charting the Citigroup Economic Surprise Index, which I'm sure you've heard of. That's the blue line, against the forward valuation, the forward PE on the S&P 500. And this goes back to 2007. So you can look at the data historically. What you want to note now is, hey, look at this big gap. You know, economic surprises. They're surprising negatively in early 2015, late 2014, and most of 2015 here. And yet valuations were lofty. So this got some people concerned. What's happening now? The economic surprises have turned back up, and we're seeing that in the data. That bodes well. So valuations have gone sideways. The economy is now going to catch up to the market, so to speak. Let's see why. So yesterday we had consumer confidence soaring back above 100 again. Very nice. Will that turn around the evaporation in retail sales that we've seen this year? I mean, look at retail sales are the gray bars here. This is from Bloomberg and Econoday. So you can see since last fall, retail sales have slowly trickled down. We got a bounce back last month, which was nice to see, but consumer confidence is still strong. That's what we want to see. And that was one of the highlights in my May piece about, strong jobs market, consumer confidence high, spending creeping up, little bit of wage growth, and housing is strong. Now, and housing is really getting robust here, and that will be a driver of more jobs and probably some upward wage pressure. All right. So the economist I want to share with you is from Barron's, Gene Epstein. He was an economist for the NYSE. He teaches economics. He's not just a journalist. This guy lives and breathes this stuff. He's been doing it longer than I have. So he wrote in the last weekend's piece, dated June 27th. He wrote, GDP on track for 3.5% growth. Outlooks are up for consumer spending, personal income, household wealth, housing, business optimism, and capital investment. Let's quickly run through his 6 bullets for arguing for 3.5% growth. And the rebound we're going to see in Q2 here. All right. I lost some of my colors and highlighting here, but I'll just go through these real quick. You can obviously read this online at Barron's. Number 1, shopping is back. Consumer spending surged 0.9% in May. Personal income is picking up, helping to boost consumer spending. Both of these are strong trends in the past 2 months. Household wealth is surging. I think at like 89 trillion in household wealth, and that's net, net worth. Number 4, housing is poised to act as a powerful tailwind. Obviously, we've talked about that. It's a big part of the expansion. Small business feels more confident. That's a chart that I showed you. If you go back to my May 27th video, 6 linchpins, I showed you the National Federation of Small Business Optimism Index, looking very tough. It's a sort of a secret indicator for confidence, because it's not the PMI surveys from corporations, purchasing managers, and it's not consumer confidence. It's in between. Small business owners, what are they doing? What is their outlook? Are they hiring? Are they making new capital investments? Are they expanding their business? Obviously. All right. Number 6, with housing and consumption on the rise, increased capital investment can't be far behind. Clearly, the thing I forgot to mention about small businesses is how many people they employ. Over half of the workforce. Now, you get that rising tide with spending and incomes and housing, that inspires corporations to get off their butts and do some capital spending, because they've got to capitalize on those consumers coming into the market and spending more on personal things for housing, etc. All right. So that's my spiel on why we're going to see 3% growth at least in the second half, and why you want to be a buyer of the dips on the S&P here, because I really don't see a big correction coming. We get down anywhere near 2,000, you want to be a big buyer down there. All right, check back with me in a week or two, and we'll see if any of this is coming true as we head into earnings season. Buy the dips into earnings season. I'm Kevin Cook. Thanks for watching.